Let's talk investing now. To do that, we turn to the Chief Investment Officer at Emirates NBD, Gary Du. Good morning, Gary.
Good morning.
Let's talk about Janet Yellen. She was speaking last night, wasn't she? Or not last night, yesterday lunchtime, a speech in New York at the New York Economic Club. And people interpreting her comments as even more dovish than normal. She says the Fed has to, this was her quote, proceed cautiously with interest rates and cue buying of stocks, selling of the US dollar. What did you make of her comments?
It's more of the same, but it was in sharp contrast with some of the other speakers we've been hearing from the Fed, who kind of given the impression to the market that a rate increase could happen even in April. That seems clearly off the table now. She's put the balance back into the market. I'm not even sure it's balanced, because I think she's really sided with the doves, suggesting that any interest rate increases, if they were to come, will be on the back of strong economic data, and quite frankly in the US, we're still short of that.
There's one headline on Bloomberg that I quite like, and it's this: Yellen takes control of the Fed message to stress a gradual approach. And Bloomberg and others suggesting that we've had a lot of Fed members offering their own opinions over the past few weeks. Some of them are more hawkish, wanting interest rate rises, some of them more dovish. And this is Janet Yellen saying, I'm the chair, this is the deal, and that's what this speech was. There's some speculation it was her taking control and kind of pulling the troops into line. What do you make of that?
No, I totally agree with that. I think, we've kind of scratched our heads in recent weeks trying to work out what is the Fed saying, because we keep hearing these individuals coming out with rather extreme messages, and particularly on the hawkish side. It's confused the markets. It's led to, I think, greater volatility than should have been the case. And remember, we're used to people like Bernanke and his predecessor, Greenspan, as kind of dominating characters on the Fed, which gives a much clearer picture to the market and takes away some of the doubts of where monetary policy is headed.
In fact, one American commentator said she couldn't have given a more dovish speech. She basically took April and June off the table.
I think that's right. I think that's certainly the way the market's going to interpret it this morning. That's why you're seeing virtually everything go up, from bonds through to equities, which is a bit extraordinary. But it is a much more dovish tone than was expected.
But what we had was the buying of stocks, Gary. Now, this was interesting. Before you came in the studio, you said you're a little bit more optimistic about risk assets like stocks now. You've been quite cautious, haven't you, for a while now. So what's changed?
We have. But I think it's when you've got a Bank of Japan that looks like it needs to do more after poor data in recent days. You've got a European central bank expanding its balance sheet and putting more quantitative easing out there, negative interest rates, and now a dovish Fed. You've got all central banks trying to get the markets higher. And again, in this kind of environment, you don't bet against that over the short term. So we think this is a time to be taking a little bit more risk, but fundamentally you've got to remain cautious, because we've still got policymakers trying to make it right, and they've been doing it for the last 5 to 7 years.
So what are you buying? What have you been buying?
We look for value, and we find some value in emerging markets at the moment. That's both in the equity market and the bond market. We think emerging market bond yields could come down somewhere between 100 to 150 basis points, which gives you a return in capital terms of around 5 to 7%. And some appetite for emerging market equities, although you've got to be careful where you're buying.
And yesterday in the States, the banks didn't do too well. Most of the large banks fell, the share price at least, on expectations that low interest rates are going to pinch their profits there. So that would, I guess, apply certainly in dollar linked currencies like ours.
That's very much the case. I think a lot of people have had an expectation, a hope from those kind of more hawkish comments we'd heard before. Interest rates will go up earlier. Banks make money out of increase in interest rates in this environment, and therefore when Yellen gave the different side of the message, it was banks that were down and everything else that was up.
One of the things she mentioned was oil prices. She talked about some of the risks to the global economy. She talked about a China slowdown and weak oil prices, and she specifically mentioned those. So let's talk about oil prices for a second. They're hovering around $40 a barrel at the moment, much better than a month or two ago. We've got this big meeting in Doha coming up next month. How are you reading the oil market at the moment?
I think we're going to see the oil price probably stay in that $35 to $40 band. It'll be interesting to see what happens post the meeting, because I think over recent trading sessions there's been an expectation, it's only a small one, that we could indeed even see an agreement to cut production, because I've seen a number of commentators mention this in their recent reports. So I think maybe we're probably towards the top end of that trading range if that expectation is built in. So I'd be very surprised if OPEC and non-OPEC countries could agree to a production cut.
You're positive on emerging markets, especially Turkey and Russia, which I'm a little bit surprised at. But what's the rationale behind that?
Well, some appetite for both those countries, although you've always got the geopolitical angle. In Russia, I think you could have a catalyst. The European Union sanctions come off in the middle of this year, June, July time, and they need to be rolled over. There could be at least some movement in Europe in order to kind of bring some of those sanctions down. So if that were to happen, I think you could have further good performance in Russian assets in particular, just on the basis of those sanctions coming down and therefore an acceleration of the better growth that we've seen of late.
Lots of imponderables about Turkey, though. Lots of things that could happen in a short space of time that could make the markets go wrong for investing there.
Very much so, but the catalyst for some better performance, we've seen some real active managers moving into that market recently, has been cuts in interest rates. We've been waiting for this, and probably not politically inspired has been the case in recent years, where it seems that the politicians were running the central bank. So again, we're always looking for that last piece of good news. In the case of Turkey, we've had it, but I would say this is a very hazardous market still with significant geopolitical risks.
Talking of political uncertainty, a lot of headlines out of the United States in terms of the US presidential race. Could Donald Trump really be the president? I guess it now is a viable option. Within the United Kingdom as well, you've got talk of a Brexit. Do either of those issues, generating a lot of headlines and noise, but when you take a step back as a chief investment officer, do they impact your investment decisions in the United States or the United Kingdom at all?
The one in the UK does worry us most, because even if you go back to that Scottish referendum not so long ago, everyone was kind of pondering on what was going to happen, and all of a sudden it looked like they were going to leave the Union, and it was a big impact across the whole of Europe. And I think the idea of one of the biggest economies in Europe extracting itself from the European Union and causing, I think, some kind of clear damage to its own economy in the near term, some maybe significant repricing of sterling to the downside against both the dollar and the euro, would be very disruptive. It would cause people to delay decisions which would impact growth. So it could be something, I think, in the near term, more important than Donald Trump.
Non-farm payrolls, the big US jobs number out in a couple of days' time. Your take on that in 20 seconds, and any other big stories we should be following this week?
Yeah, payrolls, to me, it doesn't really matter. We've got a few more people employed. They're not really getting any significant wage increases. A lot of poor quality jobs being created. I don't think it's going to be central, although we keep talking about it because it's always been an important number. I think it's going to be, will the Fed follow through on what Yellen's saying? If they do, we have very loose monetary conditions, and at least for the moment, we can still go up in risk assets.
Gary Dougan is the Chief Investment Officer at Emirates NBD. Thank you.